value investing is finding cheap companies. And it is a relative measure because it's something cheap compared to something being expensive, right? The value is a relative measure. It's always, oh, this is cheap because you're able to compare it to something else that is expensive, right? Because if not, there's no comparison, there's no basis for comparison. And does it make economic sense? Well, let's think about the expected return, right? The lower the price you pay for an asset, assuming the cash flows remain constant, the higher your return on the asset over time. And this is a numerical example. If company A costs $10 and makes $5 a year, while company B costs $20 and makes $5 a year, which company do you think will give you a better return if you were to buy it? I guess it should be company A, right? Because in 2 years, you make back the money you invested, and in year 3, you start to make $5 a year. While company B, you have to wait 4 years to make back the money you invested, and then only in year 5, you start to make $5 a year. So company A will give you a better return, right? But that's just theoretical. Let's look at a real life example to make it a bit more interesting, right? And so here we have 3 companies. Okay, and these are their share prices. This data is as of late January, so it has moved a bit by now, but the relative spots are still the same, right? So we have Intel. If you know who they are big semiconductor manufacturer. They make the chips in most of our computers. AMD, their main competitor, who makes the chips that are in computers that don't have Intel chips inside. And TSMC, Taiwan Semiconductor Manufacturing, who fabricates the chips for Apple, in all our smartphones and all sorts of other the Xboxes, and they also make the chips for AMD. AMD, designs the chips, right? Intel designs and makes the chips, so they are all somewhat competitors. But if you look at share price, Intel has the lowest share price here at 55, AMD is 94, and TSMC is 130. And you would think that. So you ask yourself, maybe Intel is the cheapest, right? It's the cheapest kind of, just because on share price. But if you look at market capitalization, actually it's not really the case, right? TSMC is a $600 billion company. Intel is 225 billion. AMD is only 100 billion. So is AMD cheaper? How do we know? Right, so one way we do that, we can compare maybe a standardizing across different companies, is to look at price to earnings ratio. And on that basis, Intel looks, in a way the cheapest, because price to earnings is the price of the company, either the share price, or you can take the entire market cap divided by the earnings of the company, or the earnings per share, right? So Intel means this 12.3 means that at Intel, you buy the shares, you're paying 12 times the current earnings, while for AMD, it's like 100 times, right? So maybe AMD is not the cheapest, right? And another measure to look at valuation is price to book. And on this is also the same. Intel is the lowest at 3, and AMD is the highest at 27. And I'll go a bit more into price to book later, so I won't dwell too much on it on this slide. Just know that it's the price divided by the book value of the company, or the net asset value of the company, right? So you would think that, hey, why is Intel trading so low, right? It's not doing as well as these other guys. These other guys all trading at high multiples, must be investors value their company. But yet, ironically, Intel makes the most money out of these companies, right? It's the highest free cash flow per share at $3.83 per share. So Intel is actually making more money than the other 2 companies for the price you're paying. So Intel, in this sense, you can say it's the value stock. It's the cheaper company because you are getting more cash back for the price that you are paying, right? But why are value companies cheaper companies? Because they are actually riskier to invest in, as their businesses are facing some challenges. And yes, to continue with our example, Intel is the company facing more challenges, right? They used to have the fastest PC chips, but they don't anymore. AMD caught up. They developed this Ryzen chip, and that's generally faster for most tasks. It's caught up in gaming performance. It's more power efficient, and until the last one that they released was actually cheaper. So they caught up and they delivered a better product, right? TSMC, who makes the chips for Apple, I mean, I'm sure you know Apple keeps making more and more advanced chips, right? They're moving to create their chips on this process called a 3 nanometer process. While Intel just announced that their 7 nanometer process is delayed, right? Delayed 1 year to next year. And currently TSMC is already on a 5 nanometer process. I mean, okay, you don't need to understand the engineering, but just know that what it means is that TSMC is 2 generations ahead of Intel in how advanced their manufacturing process is. Intel is actually behind, right? That never used to be the case. So, for that reason, the stock price is lower, right? Investors are seeing that there's a risk to Intel's earnings, there's a risk to the company's business because they're no longer the market leader. So the price is cheaper. And so if it's cheaper, yeah, I mean, the market being efficient is showing that there is some challenges facing the company's business, right? If the risk was low, share price of the company would be a lot higher. I mean, like Apple, right? Apple is the most advanced smartphone maker. They are one of the best software OS out there. They have very big market share and they have very good margins. And so the market value them as the most valuable company in the world, right? So investing in Apple is a low risk. You're buying the guy that's got the best profit margins and the strongest position. So that's why the share price of the company has gone up a lot already to reflect that increased value in the company. So this is just an example. And I mean, just to note that, of course, the returns can be very volatile because we're just comparing 1 or 2 companies here, right? It's a very, very small sample. But when we aggregate and diversify across a large number of companies, the results are more robust and you get those premiums that we saw earlier.